Hey, cool. So, hey, Aisha, thanks for jumping in and having this conversation with me. My name is Akeem. I'm a real estate agent as well as a mortgage loan originator uh, based out of New York, helping the whole East Coast get funded, very heavily focused on investors and DSCR loans. And today we're joined with Aisha Henry. Please tell us who you are. What do you do?
Yeah, so my name's Aisha Henry. I'm a estate planning attorney. I'm licensed in Illinois and New Jersey, and my license is pending in Florida. So a little bit of what I do, I draft core estate plans like wills, trusts, and powers of attorney. And I also help with some more sophisticated planning with more complex trusts for accomplishing estate and gift tax goals. And I also prepare tax returns for high net worth individuals.
Oh, that's actually really impressive. Okay, cool. So today we wanted to talk about estate planning and how it coordinates with building generational wealth. For me, it's really important that I help my community, uh,
Mhm.
you know, access generational wealth through real estate, through the power of buying smart investment properties. And we always hear people sprinkle in, get a trust, plan estates. Like, what happens when you die? Life insurance, all these things. So I wanted to bring you in so we can have this conversation and can definitely have someone that's way more educated on it than I am to really understand like what are trusts and why are they so important.
Yeah, sure. So a trust is a legal document where someone known as a grantor establishes terms and conditions for the benefit of a beneficiary. They appoint someone known as a trustee to manage the trust, to um, determine how the assets should be invested, when to sell assets, when to buy. So they control and manage the trust assets, which can include anything from real estate to cash to investments. And it's all for the benefit of the beneficiary. So you have three parties involved: the grantor or settler, who's creating the trust, establishing the terms of the trust, and you're appointing a trustee to manage it for the benefit of the beneficiary.
Okay, so what's the difference between getting a trust and just having a will?
Yeah, that's a good question. So having a trust, when the grantor is living and they create a revocable living trust for themselves, it does not provide asset and creditor protection for themselves, but in the future, it does provide asset and creditor protection for their future beneficiaries, which can include their children, their spouse, and other family members. So while the grantor is alive, it provides for disability planning. So if something happened to the grantor where they lose their marbles, they lost their mental capacity, they're saying things they didn't used to say, they're putting on their clothes where they're eating the wrong things, they're just not able to make financial or medical decisions for themselves anymore. Um, the trust does provide for the seamless transition of your assets, so that way someone else can step into your shoes, someone known as the successor trustee, will step into your shoes and help to manage your affairs while you're alive. The purpose of having a trust is also to avoid the lengthy court process known as probate. It helps to save costs and time when you pass away, to help seamlessly transition your property to your next generation, or to your spouse without going through a public process known as probate. So those are kind of the reasons why you have a trust versus a will, where a will you do still establish terms and conditions under which you want your property to be distributed. Um, However, your estate will have to go through probate. So probate, depending on the county, depending on the state where you live, probate can be very long and it can be very costly. So to avoid that, it's recommended that you have a trust.
Okay, so let's say if I have a client, it's a family, they're buying their first home, like a lot of people, they want to buy a home so they can have something to leave to their kids.
Mhm.
Like what at what point should they go ahead and get a trust?
So if you have real estate, you should absolutely consider having a trust, because a trust will allow for the seamless transition of your assets from one generation to the next. And it allows your children to inherit that real estate free from any income taxes, as
Okay.
well as protect them. It protects them from any predators. So if they are a party to a lawsuit, then if they do get a judgment from that lawsuit, that judgment is cannot touch that real estate. So the real estate will not be affected by the lawsuit. So it does also protect them if they are a party to a divorce. Their divorcing spouse cannot touch their real estate that you're leaving for them in this trust. So if you have real estate, it's, I think, very essential that you have a trust and place your real estate into the trust.
So you're basically making the trust the new owner of your real estate.
Exactly. You'd have to prepare a new deed, and the
Mhm.
deed will be from you individually into your trust.
Okay. And you have mentioned something about it being tax free. So if I put my, if I take my property, switch ownership to my trust, I don't have to pay transfer taxes.
That is correct. Yeah. So, I
Okay.
mean, varies by county and by state, but at least in the states where I'm licensed to practice, there are no real estate transfer taxes when you transfer your real estate into your trust.
Okay, cool. Because I've had stories where uh, a family would have a trust. They've left it to multiple beneficiaries,
Mhm.
and now you need everybody to be on the same page before you could either sell it, refinance it, any of that kind of stuff. So this is what we're talking about.
So, yes, it's unfortunate when families are not able to agree. And as the grantor creating the trust, you just have to anticipate these things and plan ahead for that. So you could
Mhm.
put in your trust if all beneficiaries cannot agree on how the property should be handled, whether it should be retained in the trust and rented out to get rental income, or if it should just be sold, then just put in the trust. If all parties cannot agree, then you want the real estate to be sold and you want the assets to be, um, the proceeds from the sale to be distributed to each beneficiary. Or you can say in the
Okay.
alternative, if they can agree on how they want the real estate to be distributed, then you want it to be retained in trust. So that way it can continue to earn rental income.
Okay. So you can put investment properties into trust. Like, what kind of protections does a trust have for investment properties?
Depends on the type of trust. So if we're talking about a revocable living trust for the grantor who's still living, um, there's no real protection, unfortunately. So there are a few states like Nevada, I believe Delaware, where you can create something known as an asset protection trust for
Mhm.
yourself. So like, people in high risk professions like doctors would create these asset protection trusts to protect themselves now while they're alive. But if it's an irrevocable trust, you can create an irrevocable trust, but it cannot be for you. You'd have to distribute that real estate, you'd have to put it into an irrevocable trust for the benefit of a third party, like your spouse or your children. So there are very few states that allow you to create a trust that provides protection for yourself. So
Mhm. And this all falls into just estate planning as a whole, right? Like when you're setting up these trusts and you're making all these terms and conditions for the beneficiaries, this is what estate planning is as a whole, right or no?
yeah, that is correct. Yes. Estate planning, um, it's a way for you to dictate who will receive your assets, when they will receive it, at what age they'll receive it. So it's just a way for you to set up a plan for yourself and for future generations of how you want your assets to be handled.
Okay. And who's at the table? Like when you're planning your estate, I assume, right, that you would have your CPA at the table, maybe your financial advisor at the table. someone in your position, like your attorney at the table? Like, what other advisors do you use when you want to plan an estate, especially if it's something that's coming, after you're deceased?
Yeah, though you hit the nail on the head. If you don't have those parties in your life, that's completely okay. You can speak with your attorney alone. But if you do already have a relationship with a CPA and you have a financial advisor, you have a realtor that you work with very often, then it's recommended to have all those parties in the meeting with you and your attorney when you're setting up your estate plan. So for example, I have a client who has multiple multifamilies, like multiple condo buildings and farm property. And so his realtor is always involved in the meeting as well as his accountant.
Okay, cool. So let's get down to like the meat and potatoes of it all. Like now that we know what a estate planning is and the benefits of it, like if I wanted to start today, like what
Mhm.
like walk me through that process. Like how do I start my estate planning journey and get to the end goal of having a trust and protecting my assets?
Sure. So I'll start with very bare minimum. If you do not create an estate plan for yourself, then the government will create one for you. So there are laws of intestacy in each state, and they dictate exactly how your property will be distributed if you don't create a plan for yourself at all. So,
Mhm.
for example, like some states say 50% of what you own goes to your spouse, 50% goes to your children. You may not like that. Maybe you want all of it to go to your spouse. Some states say like if you don't have a spouse, you don't have children, then it goes to your parents and your siblings. Maybe you don't like some of your siblings. Maybe you want it to all go to your parents. So you do, if you don't like what the state laws are saying, then what you could do is um, designate beneficiaries on all of your assets. So like, if you have life insurance, designate a beneficiary. If you have a bank account, designate a beneficiary. If you have real estate, most states have a deed-like form known as a transfer on death instrument that you can record with the county to say, okay, when I die, this real estate goes to these people. Um, and so those are things you can do without having a will or a trust in place. But I urge everyone to have some type of will or trust in place. So the first step would be to speak with an attorney so that you can weigh your options and know exactly what you need, because a lot of people may not realize that they could be creating problems for themselves in the long run if they don't speak with an attorney. Um, I'm finding with the evolution of AI that a lot of people are doing wills and trusts for themselves without really speaking to an attorney and figuring out like whether or not the plan that they're putting in place for themselves has any issues or obstacles in the future. So, for example, if you have a child with a disability and you leave money to them, you will disqualify them from receiving government benefits for that disability. Like people with
Oh,
disabilities should not be receiving money. They shouldn't be receiving assets directly. It should go into a trust for their benefit. So if you're creating a trust for yourself without an attorney's help, then you may be causing issues for your loved ones in the future. So
mhm.
I strongly recommend seeing an attorney so you can, weigh what your options are and plan as thoroughly as you can for your family.
Perfect. All right. Do you have anything else you want to add? Sprinkle in? Anything that, any tidbits that we should know?
I
Oh,
do, I do. So when you have real estate is a great asset to put into irrevocable trusts for your loved ones in the future, because real estate is the type of asset that will continue to appreciate in value. And when you have an asset like real estate that is going to appreciate in value, um, you want to put it in a trust to protect that asset for your children, your grandchildren, your great grandchildren, forever. Like a trust, depending on the state, can last an entire lifetime. It can last for generations. So if you put real estate that will appreciate in value, say that the value of the real estate is $100,000 when you purchase it, 40 years in the future, it's worth $500,000. If you put that $100,000 real estate into an irrevocable trust and it's later sold, that $400,000 in appreciation is outside of your estate. So, like, you're not paying the capital gains. The trust would pay the capital gains tax on any sales.
Mm.
And if you have a taxable estate, then that appreciation is outside of your taxable estate. So it's very easy to, there's a minority of states that have a state level estate tax. Illinois is one of them. Illinois has about $4 million. $4 million that is an estate tax exemption. Anything above $4 million will be taxed in Illinois. New York, same thing. New York has an estate tax, and I believe it's roughly $5.6 million. And so anything above $5.6 million will be taxed. So I know some people may be thinking, $5 million, I don't know, $5 million, I don't care. But think about it. It's the life insurance on your life. It's the value of your car, the value of your real estate, the value of your personal belongings like jewelry, your art, your furniture, your bank accounts, your investment property. It's any business interest you own. It's everything. So every single thing you own, if in the aggregate it's equal to 4 million in Illinois or more, or 5.6 or whatever it is in New York or more, then you have to pay a tax to the government before your kids or your spouse or anyone gets your money.
Mhm.
So to help avoid that, I recommend people putting assets that are likely to appreciate, like real estate, into an irrevocable trust to remove that from your estate, and that it can continue to grow outside of your estate for the benefit of your spouse, for your kids, for your family. So real estate is a great tool to put into irrevocable trust because it provides that creditor and asset protection, and it can help with estate and gift tax planning as well.
Perfect. Awesome. All right. Well, if you guys want to have any more information, you can find us both on social media. All my handles are going to be at Akeem Highland. And how can people find you?
Sure, my handle is at Aisha_E_Henry.
Awesome. All right, guys. We'll have more content coming out soon. Thank you for joining.